it's not a big surprise that we're going to devalue the dollar. The only way out. The question is what to own in a devaluing situation. Wall Street's going to tell you own stocks because as you have inflation, stock prices go higher. Well, that does this. I think investors are going to find over the next 2 to 3 years is a lot of face ripping inability to go anywhere. You're going to see markets really volatile. If you're trying to trade it, you're going to be stuck. You really need to take position, I think, whatever it may be, and not be thinking about, what's going to happen in the short term, but really be thinking about what's going to be happening in the long term and try and avoid it altogether.
Welcome to the Wiggin Sessions. This is Addison Wiggin. I am pleased to have Adam Baratta join me today. Adam and I are getting to know each other, but apparently we've been in the same space for some time. Adam is a two-time #1 best-selling author. His first book, Gold is a Better Way, was a bestseller, and The Great Devaluation was a bestseller. We'll talk about those two in a minute. He's also just released another book called The 7 Simple Laws of Inflation, an important topic for us here today in this inflationary period. He's releasing that to the paid readers of his research firm called Brentwood Research, of which he is the founder and CEO. So without further ado, welcome, Adam. It's great to meet you.
Addison, it's great to be here. I'm really excited for the conversation.
Yeah, we were just chatting about how you used to be in the film industry, and one of my questions, I produced a documentary a couple of years ago, 15 years ago or so, called I.O.U.S.A, and we were fortunate enough to go to Sundance, which was a surprise, and then we were shortlisted for an Academy Award. That whole experience is like a different world for me because I'm used to sitting in front of a computer and banging away at the keys. We traipsed around the company with a full film crew. Nobody does that anymore because you don't need to. The technology that we're actually using to film this session of the Wiggin Sessions is as good as a full-size camera when we were filming I.O.U.S.A. So we don't need that kind of stuff anymore. And we were just talking about how we set up. We're both kind of operating independently out of makeshift studios, all things that were ushered in by the pandemic. So I wanted to start with your backstory as a filmmaker and what led you to become a financial publisher, and then what kind of, I'm interested just out of curiosity, what you see as changes in the film industry and in the publishing industry as you made your way through both.
What a big topic.
Yeah, great.
So I imagine some of our subscribers are probably going to be hearing this, and in an effort to streamline our story that they haven't heard before. I was in the entertainment business for close to 22 years after college. That kind of all came to a crescendo. I was partners with a guy named Stan Lee of Marvel fame, creator of Spider-Man, Iron Man, X-Men. And, I went from the ranks of an actor to a writer, to a producer, to a director, to a producer. And Stan had an idea to, he had dozens and dozens of superheroes. He wanted to create the next Marvel. And he couldn't figure out how to do it. Together with another friend, had the idea of turning sports teams or like the NFL into superheroes. And I sat down with Stan. I was a pretty, up and comer at the time. And I said, I'm going to get you a deal with the major sports league. And the part of the story that, maybe people haven't heard before is my first big meeting was with a guy named Jerry Jones, who owns the Dallas Cowboys. And what I said to Jerry Jones actually applies today. So we'll wrap it around at the end, Addison. But what I said to Jerry is, I said, I don't know how many kids in China know who the Dallas Cowboy is. They all know Spider-Man. They all know Iron Man. They all know the Hulk. And when we're done with this property, more kids around the world will know who the Dallas Cowboy is, not because of football, but because they fall in love with our stories and our storytelling. This is 2008, and Jerry Jones says to me, "That may be the best goddamn pitch I ever heard." And 2 weeks later, we were at the highest levels of the NFL. That led to a few-year odyssey where we had this development deal with the NFL and turned all their teams into superheroes. That kind of went sideways because the NFL was trying to take everything. And so we took it over to the NHL. And ultimately, it also informs kind of how I got here, because we were trying to raise about $50 million in a completely different environment. The best idea, entertainment idea, so many people have heard, and it's incredibly difficult to do because you're combining the trademarks of, a major sports team with a major superhero creator who owns it, all of the, issues around the trademark and the copyright. But ultimately, if I was, doing that again today in this, highly liquid environment, I'm sure we could raise the 50 million in, less than an hour. So kind of that story sets up how I got into what I'm doing now. We couldn't raise the money. And I had several $1 million of my own and friends and family money in it. And I tried to keep it going, became the exclusive focus. So I spent about 4 years of time completely devoted to it. And ultimately, I got evicted from my house. My car was repossessed.
Oh
I literally had, I needed a job. And I decided to leave the entertainment industry to go and, I wasn't going to do it for long. I got a job selling gold. A friend of mine was selling gold at a company, and I went over there. And what's crazy is that I fell in love with a completely different story. And that kind of led to, the new career that I've been on over the last 8-9 years.
And so is that when you founded Brentwood?
No. So the progression was as follows. I go to this other gold company, and immediately I recognize that the way gold was sold, and still is, frankly, is this fear-based political agenda. The world's coming to an end, and why you need to have this insurance policy. And I was coming to it not from Wall Street. I didn't learn all of the financial modeling and the BS that happens in on the Wall Street space. And I dove into getting what I think is probably a master's in trying to understand investing. And in that process, I realized that there was really a much better way, that this story was way better. I said to my friend, "Why are we doing this here? I think we can do this a lot better." We formed Advantage Gold in 2014 with 3 employees. We're now the #1 firm in the country. We've got over 50 employees, and it all started with education and helping people to understand the why that they would be doing something, not out of fear, not out of a transaction, but as a big piece of the portfolio and the reason why. So, that's how the story of Advantage Gold unfolded. And as we mentioned earlier, one of your close relationships in 2016, Jim Rickards, we did a special offer around the new case for gold. And he and I spent a lot of time talking. I was doing a lot of thinking about it, and I just started writing. And I wrote a book called Gold is a Better Way. Went on to become a #1 national bestseller. It was released at a really, good time. Gold was under $1,200 when it was published. And, I had no idea I could write, Addison. I'm nowhere near the talent that you are, for sure. I'm nowhere. This is that 10,000 hour thing. You get better and better at communicating that over time. So I think I'm pretty good now. But back then I had a purpose, and that purpose was to send a message. And for me, the message was simple. And I put it right on the cover of the book, that gold would outperform financial assets over the next decade. And the major conclusion of Gold is a Better Way is that in a growth environment, you want to own financial assets, stocks and bonds. In a debt environment, you want to own gold. And so still, the very first thing you do if you come to the platform, I created a platform called Gold is a Better Way. The very first thing you'll see is the scoreboard. I happened to check it out right before getting online here with you. And since the book was published, gold is up 62%, silver is up 58%, the S&P 500 is up 39%, the Dow Jones is up 32%. So gold is outperforming equities roughly 2-to-1 in just the 4.5 years since it was published. And, you know, our subscribers know that the platform is one of the most robust educational platforms that you can find on this topic and in this space. So that's kind of the genesis and how we got to the financial publishing.
So Gold is a Better Way, and then you followed that up with the Great Devaluation, which is kind of like a sequel in a way, right?
Yeah. So
that's the debt environment imploding.
well, you know, it's interesting because the focus of Gold is a Better Way was for investors, you know, comparing financial assets to commodities, tangible physical assets. And in that study, I learned a tremendous amount about the Federal Reserve, right? And ultimately, one of the conclusions of Gold is a Better Way is that the Federal Reserve really controls the equity markets. And it's really controlled by their balance sheet and by interest rates. And as the Fed expands the balance sheet and lowers interest rates, stocks and bonds go higher. And when they try and raise interest rates and reduce the balance sheet, financial assets, stocks and bonds come down. And ultimately, I believe that most investors don't recognize that one truism. The second piece is that there's this idea that gold only works, you know, if interest rates are higher, gold doesn't work because gold pays no yield. And ultimately, I found the exact opposite to be true. When interest rates go higher over time, gold dramatically outperforms stocks. It's when interest rates go lower over time that stocks and bonds outperform gold. And there's one main reason. See, most people are now looking at the debt. We're going to talk about that. I'm really excited to talk about that. And the Great Devaluation is really about, you know, a super cycle and a asymptote of debt. But what most people misconstrue is that the higher debt goes, the higher the price of gold. And it's not true. The key for gold isn't the level of debt, it's the costs to service it. So a real quick, easy way to understand that, from the year 2000 to 2011, our cost to service debt went from 300 billion to 450 billion. Okay. Our debt was going higher, interest rates were rising in the early 2000s, and our costs kept going higher. And as our costs went higher, the price of gold went higher, from about, you know, $250, $300 an ounce to about $1,600. And then what happened, you have QE to get us out of the housing collapse. QE2 happens around 2012, and you now have the Fed liquidating the world. And what it meant was our cost to service debt from 2012 to 2016, even though we were going further into debt, actually came down. Went from 450 billion a year down to 400. Gold prices dropped from an average of 1,600 down to almost 1,000. So the big premise of Gold is a Better Way is, as interest rates go higher over time, you're going to see the price of gold go higher. And when the Great Devaluation, you know, when I got the idea for that, it was because Jerome Powell pivoted. You know, the idea was, we're going to run the balance sheet off, we're going to raise interest rates, everything's going to be fine. It's going to be like watching the paint dry. Remember? You know, that was the story from the Fed. Of course, they caused a financial collapse. It happened to be that Gold is a Better Way was published at that time, which helped it become the #1 bestseller. But Powell and what he did changed everything for me about my long-term perspective. And when he pivoted and stopped raising interest rates, I started buying as much physical gold as I possibly could, because this is the key. And what we're going to talk about right now is the Great Devaluation is about a debt situation that has built for 40 years. and has hit what's called an asymptote. An asymptote is a curve on an X and Y axis that at some point starts shooting up towards infinity. And the easiest way to kind of picture this is that, 8th grade math question that gets asked, which is, what is a penny doubled every day for a month? What does it add up to? Most 8th graders think it's a trick question, and the average answer is $500, right? And that they think that that's high, but a penny doubled every day crosses the $500 threshold on day 17. At day 23, it's 83,000. On day 31, it's $5.5 million. And so that's an asymptote. And the numbers don't even start to hit you until you get later on into, that equation. But that works with things you can't see. So if you do that same experiment in, a deadly virus that starts in a glass that you can't see, and then you watch that for 60 minutes, well, if it doubles every minute, I did a thing before the pandemic hit, which really launched Brentwood research, called the Black Swan. And it was based on this idea that we were going to have a black swan. And the reason is that we can't see exponential growth as it's occurring. And so I showed this visual of these glasses over 60 minutes. And what you see is you can't see anything with the human eye all the way up to minute 51, 52. Then you just see a little layer of film. It's not until minute 55 that you have like a 1/16 of an ounce. It's not till minute 59 that it's halfway full. And so I said our debt is 1 minute to midnight. It's growing, it's doubling every 8 years. And it's hit an asymptote. So right now we are 1 minute past midnight. The answer is the glass doesn't become half full until minute 59. At minute 60, it's full. At minute 61, it's 2 glasses and it's uncontainable. At minute 63, it's 4 multiplied by 4. And so you can't contain it. And then I liken that to our debt and how there's a moment where you can't solve the debt problem through growth. In fact, the more you grow, the more you owe, okay? Real growth makes interest rates go higher. Interest rates going higher into a $32 trillion debt raise our cost of service debt. So now we're in a debt spiral. And the more we grow, the more we owe. We've gone from $500 billion a year in cost of service debt to now $736 billion in just 2 years. So when the Federal Reserve, and this I think is now, this is what I could see well before anyone else. And that's why I really believed, what's the end game? The end game, very simply, is, where are you going to be, 7 years from now? It's hard for us to kind of think about the future in that way, particularly when we're so momentum driven and now everything's at, the touch of our fingers. We can check our accounts constantly. The whole world has become, poverty mindset. One of the ideas of the Great Devaluation is a poverty mindset thinks day to day, thinks moment to moment. How am I going to survive today? A middle class mindset thinks, month to month. How am I going to pay the rent? How am I going to pay the mortgage? How am I going to pay the car payment? A C-suite mindset thinks year to year. Am I getting a bonus this year? Am I moving up the ladder? But a wealth mindset thinks decade to decade. And I was preparing for 2030. And because we speak to long-term investors, it doesn't really matter what happens in the short term. What matters is where we're going. And if you can set a proper plan in preparation for all of that, you don't have to worry about the volatility that's going to happen as this all gets adjusted. You just need to know a couple things. Our national debt doubles every 8 years. Bush doubled the debt of Clinton. Obama doubled the debt of Bush. Trump and Biden have now on pace to double the debt of Trump. And we're going to be at $36 trillion in debt by the time Obama's done. By the time Biden's done. And by the next 8 years are going to be at 60, 64, 65 trillion dollars. So you start to do that math and you go, well, how's that possible? How can we do that? How is it possible, especially if interest rates stay elevated, which is what the Fed is now telling us? It's an impossibility. 5% of 30 trillion is 1.5 trillion. 5% of 60 trillion is 3 trillion. We only bring in, 4.9, $4.5 trillion in taxes. So you get to a place where the cost to service debt eat up everything in your budgets, and it's now fiscally impossible. And it's why you're seeing this, tug of war between the smart money, who's betting that the Fed is going to have to cut rates, and the Fed, who's saying that, no, we're going to get up to 5.25 and we're going to stay there. I can tell you, I don't know what's going to happen in the next, 6 to 12 months, but I am darn sure that you're going to see the Fed lower interest rates to 0% again. And then they're going to expand the balance sheet massively. It is the only way. Ultimately, if you're convinced of that, once you become convinced of that reality, well, then you can start making decisions that plan for that and position yourself as a long-term investor. And that's what we talk about at Brentwood Research. Sorry for that long answer, but hopefully that set the stage a little bit.
Yeah. It's interesting because I just, the day before we're talking today, finished the final touches on the 3rd edition of Demise of the Dollar. And I was doing that exact same calculation on the service of the debt. And it's only 2026 before the service on the debt crowds out all other services. And they always talk about raising the debt ceiling. We just went through another bout of political theater over raising it again. And it's almost irrelevant if the cost of servicing the debt crowds out things like being able to pay Social Security or Medicare or all the big promises that are already on the books. Sure. And just financing those programs becomes untenable if all of the tax revenue has to go to pay just to pay on the borrowing we've already done. And I like this analogy of the asymptote because it becomes the purpose of government becomes to service its own debt rather than to provide the services that politicians promise just to get into office. It's pretty crazy.
Well, you're right on. And now take a step back and go, okay, well, what is the solution? See, our solution has been, the big prediction that happened, why the Great Devaluation exploded. We were #1 Wall Street Journal bestseller for multiple weeks, was for one prediction, which was when the next black swan comes. The Fed's going to lower interest rates to 0 and then massively expand the balance sheet. You have to understand why. On a balance sheet accounting, okay, the math that you and I are highlighting now for our subscribers is that's the math. You're going to crowd out everything else fiscally if interest rates rise. So you need negative interest rates. That's the only way forward is interest rates that are negative. How do you get the negative interest rates? Well, if you lower to 0, you have no more room. You've got to expand the balance sheet. So there's one of two things is going to happen. The Fed has now gotten interest rates back to close to 5%. In every recession over the last 50 years, what the Federal has done in a recession is lower interest rates 5%. It's their first move, okay? Once they lower interest rates 5%, that reflates, that opens up liquidity, it kind of stabilizes markets. The Great Devaluation, interest rates were 2.25%. And I said, how do you take 5% from 2.25? Well, it's negative 2.5. So if we stay on a global system that is balance sheet accounting, the only way to run $60 trillion deficits is with a balance sheet that's $15 or $20 trillion. I think, and this is why the subtitle of the Great Devaluation is called How to Prepare for the Global Monetary Reset. It's unsustainable. And it's not only unsustainable here, it's unsustainable in the G7 countries. It's unsustainable everywhere. And, you know, the setup has helped me now explain how what I'm focused on, the publishing, has grown. I started off talking about financial assets. I then started talking about this debt structure and this, asymptote of debt, and how the more we grew, the more we were going to owe, and we were going to like cannibalize ourselves. I'm now talking about what I'm seeing in the world. You see what's happening in the Ukraine, what's happening with Russia and China. People, misconstrue this, I think, as he's a crazy madman who's doing something in the moment. This has been a planned situation for nearly a decade. We did the publishing, Addison, has gone from the books to, newsletters to trade events. I've only done 3. And, I've done them because I'm not trying to win every single day, and there's not always a great opportunity, but they've been incredibly successful. And what I do is I pick an end date and I think through 6 months, 9 months in advance and go, where are we going to be then, based on other things that I believe are happening. I've been watching the situation in the Ukraine. Putin had 100,000 troops outside of the Ukraine in September. Okay. He didn't go in until February. And I wrote a report called 22222, which said that we're going to have a big monetary event at the end of February for one reason. China was hosting the Olympics. The closing ceremonies were on the 20th. I didn't think China was going to allow it to happen before the closing ceremonies. And it's crazy. They went in on the 28th. So Putin, Xi Jinping, the commodity and labor producing countries are fed up. They've been holding our dollars in reserve as their savings. They ship out their materials, their resources, their labor, their oil, their energy. We consume it all and we ship them dollars. And what have we done? We've taken our balance sheet from 800 billion to, 9 trillion. We've taken our debt from 5 trillion to 32 trillion. And they're still getting paid the same amount for the oil. So this is a monetary system that has benefited the G7 countries at the expense of the BRICS, Brazil, Russia, India, China, now add Venezuela, Saudi Arabia is not on board anymore. And so we're facing, and this gets me to the 7 simple laws of inflation, which we just released. Okay. Listen, I'll be the first one to give everyone a secret if you want to trade it. CPI is going to go down over the next 6 to 12 months. Okay. And there's one main reason why, because the way that the Federal Reserve reports, the Bureau of Labor Statistics reports CPI has changed. It used to be a 2-year aggregate. It's going to be a 1-year aggregate right now. So when you see March CPI, it's going to be compared to March from last year, which was, CPI was the highest in 40 years last year. So relative to last year, CPI is going to go down. It's going to fuel this idea that the Fed, solved the inflation problem. But I'm here to tell you, this is exactly what happened to Arthur Burns in the 70s. It looks like you've tamed inflation, but the reality is we're in the middle of a globalized world that is now becoming bifurcated. We're going from, get it anywhere, anytime to near shoring, right? It's close enough in the supply chain. And ultimately, the 2 main drivers of inflation are energy prices and labor. And you're just going to see the more you have to nearshore, the more you have to invest in new technologies around energy. We don't need, as a country, to spend less. I mean, we've got, a Social Security unfunded liabilities of $74 trillion. We've got a national debt of, 32 trillion. And we've got a energy transition that we have to invest in. Our infrastructure is broken here in this country. Our systems are broken. Look at what's going on with, each of these, presidents and vice presidents now have documents in their home. Our system of checks and balances is broken. So we need new systems. It's all going to cost a lot of money. inflation is not going to go anywhere. You're going to see elevated inflation for the next 5, 7, 10 years. And what you need to understand as an investor is in times of elevated inflation, stocks and bonds perform terribly. The 60-40 model is going to get really, really, really struggle. And you need a new model for that environment. And I love what you're doing. I'm reading it. I think you're right on point. But these are the reasons why I'm so confident myself, and why I'm so passionate about it. Maybe you can kind of see that, because Addison, Wall Street has the ear of the regular investor. Okay, they turn on the Cartoon Network, CNBC, and they think they understand. And most people just follow the stock market. And they've got this idea that stocks always go higher over time, 10% a year, and that's what we do. And until that, people realize what really drives financial assets and how that really works, most investors are just not going to hear this story. They're not going to get it in mainstream media. And it's why what you do is so important. Hopefully we're adding some value as well. But this is really the story that if you're a long-term investor, you've got to, have your own conclusion on. So, that's a fair summary, I think, of everything we're doing.
Yeah. So there's two things that you've said that I think are important to highlight. One is that we're entering into a period that's very similar to the early 2000s, where debt servicing, the cost of debt servicing is going to rise precipitously, I believe, for the next decade. And in that environment, as you point out, gold does well. And also the CRB tends to do well. A lot of the real assets of the world, they tend to do well when debt servicing goes up. And so that's an important thing. The other important thing is that the way you're describing inflation is a little bit different than the way people perceive inflation. So I was just writing about this too. So it was kind of a little bit of a pretzel logic you have to peel it apart before it tastes good.
Right.
Inflation is effectively just increased money and credit in the system. The rising prices that people see is the symptom of inflation. It's not inflation itself. Most people confuse it. They go we just went to pick up some eggs and bacon yesterday. There was a bunch of girls here because my daughter is 16. She had a bunch of friends over. We were making breakfast. We went to get eggs and bacon, and eggs, it's a national story that eggs have doubled in the last year. And bacon is up. Just one slab of bacon is like $7 now. And, if you're not paying attention, you just buy it and, whatever. But if you're actually paying attention to the prices, they're going up precipitously. But that's the symptom of inflation, not the actual cause of it. What we see is the price. What's actually causing it is this flood of credit, consumer credit, and the rise in M3, which is cash in the system. There's so much money flowing into the system since the pandemic that it's actually causing the price rises. And also you have the supply chain issue where, things like grain and stuff like that are also going up because there's not as much supply. And the way I was trying to describe it is the Fed is trying to attack the demand side because they want to diminish the demand for things that require, say, grain, which comes from the Ukraine, more or less, not always, but a large part of the world's grain supply comes to the Ukraine. So they're trying to crush the demand side so that the supply that's there can rise to meet demand, and then prices won't rise. I mean, that's a supply and demand. But the actual root cause of inflation is so much credit and just cash going into the system to try to fuel the economy while the Fed is trying to crush demand. It's a very confusing situation, and it's the only other time we've seen it in our lifetimes is in the 70s. So it's a very similar situation to, as you point out, what Arthur Burns tried to deal with, and then ultimately Paul Volcker came in and had to chase rates up. I talked to Paul Volcker about this once. He didn't raise interest rates as everyone gives him credit for doing. He had to chase interest rates up in order to fund the government. People were giving up on treasuries and buying bonds, or when they were trying to roll over debt, they were having a difficult time to do it. So he had to chase the rate up to the point where he could raise the money to fund the government.
You said something which is it's confusing. And it's exactly why the purpose of the last book I wrote, which is the 7 Simple Laws of Inflation. And, it's only for subscribers. I'm happy to make it available to your audience, Addison, but I'm going to make it simple right now and quick. Inflation is the easiest thing to understand. It's when the money supply grows faster than the productivity. Okay. Our money supply growth is averaging 7% a year over the last 20 years. Our productivity growth is averaging 2.5%. So we have had inflation over the last 40 years. I start off the book with the law number 1 is inflation is relative. Okay. I'm a sports fan. You may remember, I don't know if you do, who the first athlete to get paid $1 million was. Do you remember who that was?
I do not.
Okay. First athlete to ever get paid $1 million a year was Nolan Ryan in 1980. Okay. The highest paid pitcher in baseball today gets $44 million a year. John McEnroe won the U.S. Open in 1980, got paid $47,000. Alcaraz won this past year, got $1.6 million. A Super Bowl ticket cost $30 in 1980. It costs $7,500 today. Okay. So we've seen, if I told you that in, 40 years from now, that the highest paid pitcher in baseball would make $1.7 billion, or that the winner of the U.S. Open got paid $160 million to win the U.S. Open, or that the cost of a Super Bowl ticket was $1.5 million, you probably go, wow, that's crazy inflation. Well, I've just applied inflation of the past to the future. Now, however, go look at the cost of a hot dog and a beer. That famous stadium combo in 1980 cost $6. Today it's $12. Now think about the guy pouring the beer and serving the hot dog. Minimum wage back then was $3.10. Today it's $7.25. So what you've seen is this massive inflation in some things and no inflation in others. And it's what we call good inflation and bad inflation. But the key is, and why I'm so certain we are in a middle of a turning, is because you didn't need to be a famous baseball player to see a 40 times increase in your portfolio. All you need to do is put it in the stock market. Stock market's up 40 times since 1980. So we've got this idea that we just put our money in the stock market and it grows. Well, that's happened while the laborer has seen almost no increases in their wages, while commodities have gone almost nowhere. And ultimately, the inflation of the 70s was simply a reset of all of those same inputs that had happened from 1955 to 1970. We have the exact same situation over the last 15 years as we did then. And once you can get your mind around, wait a second, higher commodity prices is really just resetting all of the money printing we've done. Until we get to levels where they're reset, we're going to be in crisis. We're going to have an economy that is struggling. And how that reset occurs, if we stay on balance sheet accounting, we're probably going to, it's going to be an erosion over time. It'll be gradual, it'll be painful for investors, but it could happen suddenly. And when you think about suddenly, that's what happened in 1933 when FDR made holding gold illegal. That's what happened in 1971 when Nixon closes the gold window. And we're right at that same reset now. The dollar has become way too strong relative to real tangible things. And the dollar needs to weaken dramatically in order to, justify those prices. And if you allow me, it really defines, make America great again. Donald Trump recognized this reality because what's happened is that our dollar has allowed us to go import everything from other countries. The middle class has gotten wiped out. We don't invest here in our country. As we were raising interest rates, the dollar went to 114, right? I'm sure you know that. And, everything else was pressured, but we're exporting our inflation to everyone else. Really interesting analogy about the dollar and its global power and reserve currency status. Dollars are used in 88% of global transactions, okay? I liken the dollar to the universe. Neil deGrasse Tyson taught us that the universe is constantly expanding. And in order for the universe to keep expanding, we've been moving through Earth. The Earth is moving through at 70,000 miles an hour through the atmosphere, right? Anytime it stops expanding, it creates black holes. A black hole is just a gravitational pull that sucks up all the light. So when that's akin to the dollar. As we expand the money supply, we allow everyone else to grow. When we try and bring it back, we create black holes in the global economy. That's why you're seeing, uprisings around the world right now, runaway inflation, because we're contracting the money supply and they can't grow. Ultimately, I believe it means you're going to see a standoff between the commodity labor producing part of the world and the G7 countries who have financialized, manipulated, and that face-off is going to be result in much higher prices for commodities and labor, or a war, maybe both. So, hopefully some of those analogies are easy for people to recognize, but it's very simple. We are headed for a highly inflationary environment.
This is a conundrum that I haven't solved enough to have a firm opinion on. But generally, as you pointed out earlier, when crisis hits the financial markets, the Fed lowers rates. They're up around 5%. They have to get them down back to 0 or whatever in order to support the financial markets. If we're already in an inflationary environment, the only tool the Fed has is raising interest rates to slow demand, as we've talked about. What happens when there's a financial crisis and inflation at the same time?
It's such a great question. It's such a great question. And I think about it the following way. Look, the guys at the Federal Reserve aren't dumb, okay? They've got 400 economists all there working on this stuff. They know what's coming. The reality is, Jim Rickards is, he talks about in currency wars, he's in the room, doing war games, right? Do you really think that someone didn't say, wait a second, if we freeze the reserves of Russia, aren't we telling the world that dollars really aren't dollars, that they can be frozen at any time? And if we freeze Russia's, maybe we could freeze yours, and maybe as central banks, you want to hold less dollars? Well, that goes to the wealth mindset. Central banks think in decades. You're seeing central banks buy more gold at the highest pace that they have since 1967. Everyone can see what's coming. So what's going to happen? I think you have a choice. In 2000, 72% of the global central banks' holdings were in dollars. Today, it's 61%. So 20 years from now, if it's 50%, well, you're going to see gold prices at 6,000, 8,000, 10,000, because what are they buying instead of, currencies? They're buying gold. And getting it back to gold for 1 minute, gold is an asset, not a liability. We can't freeze Putin's gold, okay? If Putin had a stamp on it, giving the middle finger, saying F Biden on one side and mooning, on the other side, F everyone else, every country in the world would take his coin, because gold can be melted down and restamped. It's not about the stamp, it's about the element. So why is gold the core of the monetary system still? Because you can't steal my gold. You can't turn my gold off. You can't freeze my gold. You can't sanction my gold. And ultimately, that's what the reset looks like. A much, much, much higher gold price. And that's going to reset one of the ways the system gets reset. That makes sense?
Yeah, it does make sense. And just this is just a detail, but after the war and the sanctions were put into place, after the war began, and then when the West started sanctioning even the oligarchs personally, they started repricing their oil and natural gas in rubles. And then the discussion is going on. They haven't done it yet, but the discussion is going on that they would begin backing rubles with gold, in effect, creating a situation like the dollar had until 1971, but for rubles. There's a debate going on among the more nerdy of us who talk about these things, that the dollar still has the legal infrastructure and the existing contracts that it would take a massive unwinding of the financial system for the dollar not to be the reserve currency of the world. But all it really needs is a competitive alternative. And one of the things that Russia's doing to get, or Russian oligarchs are doing to get around the sanctions, is they're pricing oil in rubles and they're selling it to businessmen in India. It gets shipped to India and then it becomes Indian oil. And then they're not even taking it off the boats.
Right.
They're selling it to Europe or to the U.S. or whatever, wherever they need, or to Brazil, whoever will buy it on the global market. It's a very interesting thing. And all it does is raise the price of oil because it has to go to different ports and everyone's going to take their cut. And also it raises the transactional value of the ruble. So that is just, I mean, that's just a kernel of competition for the dollar as the reserve currency. It would take a massive financial crisis to unseat the dollar as a reserve currency. And as we've seen in the 20th century, going into World War I, the pound was the reserve currency of the world, and it took 2 world wars before the dollar kind of took over as that. So the type of crisis that we're talking about that would unseat the dollar as the reserve currency of the world would be a massive, probably just a massive war that destroys everything, and then we get together and have Bretton Woods too.
Well, it is a conundrum, and the conundrum has a couple of possibilities. I'm worried, frankly, that you're right, that the dominance of the dollar is one that won't be overcome. And I think that if you're so you're a central banker, you're Jerome Powell, what is your end game? Fiscally, this is unfeasible. You're about to cause a serious recession if you stay at these levels. Well, my feeling is the end game is they're going to try and get to a central bank digital currency of some sort.
Yeah.
Because if you're in a central bank digital currency, well, now you can actually do negative rates. Okay, if everyone's stuck using the same currency, well, now you can have negative interest rates. You got $100,000, it'll be worth $97,000. You won't be talking about inflation. They'll just take it right out of your account, and there won't be anything you can do. And I'm talking about this macro topic in the Return to Real that I'm writing, Addison, because we've given away our most valuable information, which is our, data. We've given it away to the Googles, the Facebooks, the Microsofts, the Apples, and we've gotten great convenience out of it. Okay. But we're now patterned to think it's okay to give away all of your information. So we've been programmed into this central bank digital currency where we're all, aligned in this digital world. But the problem is when the federal government says, oh, you spoke bad about the president, you don't get your universal basic income payment this week. You use too much energy, you don't get to buy gas for your car. You drank too much wine this week, so transaction denied. And these things seem like, sci-fi crazy stuff out in the future, but ultimately getting to a central bank digital currency solves the Fed's problems. It allows for exactly what they need to have happen, which is this just never-ending expanding balance sheet. So I think we're going to get, there's going to be a battle over this. It's another reason why I like, physical gold personally, because you can control it, you can own it. There's no one else that can take it from you. Seeing where this is all going it seems like not only for the price in the future and why I want to own it, but also for having control over my own, assets. It's one of those things I think every investor is probably going to want to own.
Yeah, on the question of the central bank digital currencies, or it would be the Fed coin or something like that. That's what it's been dubbed. It seems implausible. It seems like science fiction, like you say. But there were two events in the past 15 years that seemed implausible. One was a 3-page memorandum written by Henry Paulson sent over to Congress to set up the bailout programs. Like, that was implausible 3 or 4 years before that. No one would have thought that was possible. And they just rubber stamped it. It was like, here's the Treasury Secretary saying, the financial, if we don't do this tonight,
Right.
the financial system of the entire world is going to collapse. And they're like, oh shit, we better do that.
Right.
And then they did it. And like the entire financial world was like, wait a minute, can they do that? that seemed implausible. And then the second was, I remember the day I was actually sitting right here doing an interview when the city of Chicago shut down all the restaurants in the beginning of the pandemic. And I remember thinking, that is impossible. Like, how can the city do that? And then within a week, the entire freaking economy was shut down. That seemed implausible. Like, that seemed implausible on the day it happened. Like, no way, they're not going to shut down. And then the entire globe was shut down. So that for me, those two events make the idea, or like the reality of a CBDC, seem less or more plausible. Like, they're going to do whatever they're going to do, and it's not a democratic process. It's not like nobody gets to say yes or no, I want to be a part of that system or not. It's a very authoritarian, crazy mindset for if you grew up in a classical liberal Western democracy, that those kind of things can happen, and people just roll over and accept it. I did too.
Sure.
Like, what else am I going to do? I have to.
Here's what it is. Here's what it is. What seems crazy in normal times becomes necessary in a crisis. Okay. Look, we've seen this. You've pointed out a few. Go back to the Patriot Act. I mean, this thing was passed in the middle of the night, took away all of our freedoms and liberties because we're in the middle of a crisis. The TARP package passed overnight because we're in the middle of a crisis. The Federal Reserve, the amount of hand-wringing that happened about the first expansion of QE was massive. QE2 happens, QE3 happens. What's the first thing that happened when the pandemic happened? Look, between you and me, I think the Fed caused the financial collapse in 2020. They came out with an emergency meeting. We're lowering interest rates to 0%. The stock market was fine prior to that. What did they do? Without any oversight, without any checks and balances, took the balance sheet from 4 trillion to 9 trillion, and everyone just rolled over and accepted it. So to think that these things can't happen is short-sighted, because when you have no savings, crisis happens regularly. Okay. And this is the thing of the black swan. I lived through it. Okay. When you've got savings and you're doing well, and you're prepared for some crisis moment, it's no big deal. But when you're literally living, day to day, and then a crisis happens, you're stuck. You either pay the phone bill or the electric bill. You either pay the rent or your car payment. You don't get a choice. And where we're at right now is we have zero savings. We can't afford a crisis. And so it makes you start to wonder, the Federal Reserve knows this too. Are they actually trying to create that crisis so that they can really speed up the next transition? I said that I believe the Federal Reserve is one of the most political organizations that exists. They make their claim to fame is we're apolitical. No chance. The Federal Reserve wanted Donald Trump out. You know why I believe this transitory story kept going, and I was writing about it as it was happening. They wanted everyone to forget Donald Trump's promise, which is your 401k is going to go down 50%. So if they didn't liquidate the world, they didn't keep pumping into the system, that's precisely what would have happened. And we all would have been, going back to, well, we want Trump back. Oh, our portfolios don't need Donald Trump. Oh, we've gone from 3,200 to 4,800. We've all forgotten it. But the reality is they pumped it that way. Well, if you like that story, be worried about what's coming next, because we've got an election coming up in less than 2 years. The best way to go into an election is coming off of a down. So if you think the Fed's going to pivot and you can connect that maybe they are political, and then you can connect, well, they really need modern monetary theory to absolve them of all of their sins over the last 30 years, because that is the way out. You go, okay, maybe they're okay creating a collapse in financial assets. Maybe that's their goal, so that come February, March of next year, we're coming off a base, and then we can get some momentum going into the election, and we can now win in 24. How do you win coming off of 4,200 or 4,400 on the S&P? Not when it's this dramatically overvalued and you're raising rates. Can't happen. So you become a bit of you look like a conspiracy theorist when you start out. I wrote Gold is a Better Way. People are like, you're crazy. Okay. But now this is starting to become something that people really are, that's right. Retail has yet to come into. The gold is the one thing that reveals the Federal Reserve. Okay. It's the canary in the coal mine that says their weakness, it calls them out. The retail hasn't even come into gold yet, Addison. Okay. We talk to people at Advantage Gold every day. 75% of the people we're talking to are people who have never bought or considered gold before. They're just coming to it now. So what we've seen so far in the move up in gold price has been institutional. It's been central bank. The real momentum is going to come. And, it's all happening right now. Your series that you're doing is so critical for people to understand that story. And it goes back to that whole why I'm so passionate about what I do. I think more people are going to come to change the way they invest, change the way they prepare, not because of the price, because they see it going up or down, but because they understand the story and they're investing in that story because it makes so much sense. And why I think you're seeing a turning in the way, investors look at the world right now. So, I think that may tie together some of what we talked about.
Yeah. So let's go. I just want to go back because I just want to make the point clear. If let's just take the premise that the Fed is engineering a financial crisis.
Okay.
Let's just say that, or that the uncertainty in the market triggers a financial crisis because people, like you're saying, the SP is overvalued. And we're as individual investors, but more on the institutional level, people are aware, like traders are aware that they're trading at high valuations and they're nervous about it. So it doesn't take a lot to get to teeter on the edge and start going down. And once it starts going down, it's self-fulfilling. Do you see the Fed trying to lower rates even if there's high inflation still in the system?
Well, the way you phrase that question is, what are the inputs that we're looking at to tell us we have high inflation? I think that probably the Fed's going to get a lot of help with the data because of how we're restructuring the definition of it. So if CPI is going down every month, and the asset values are going down and the unemployment's going up, well, the Fed's going to say, okay, job accomplished, we can now lower, right? Structurally, though, if that happens, which I think it likely will, it can't happen. This is the problem for investors, as I see it. You can't get higher without the collapse. Because if assets value stay this elevated and financial conditions remain this loose, the Fed's going to have to keep, pressing on the brake. That's going to be their only option. So, is Jerome Powell Paul Volcker? No chance. He can't be. Paul Volcker was working with a debt that was, 35% of GDP. We're at 125% of GDP. It's a completely different world. There's no chance that Powell can be Volcker without creating a dramatic recession. And so, there's a guy that you may know, Ken Rogoff. You familiar with Ken?
Yeah.
Ken is, was at Davos this past week. Ken was in our offices and gave a private interview to me after I wrote Gold is a Better Way for our team. And I asked him then that the national debt was only 22 trillion, Addison, okay, at the time. I said to him, is our debt situation
only 22 trillion?
Only 22 trillion, right? I said to him, is our debt situation unsustainable? Because it was really my premise that this debt situation is becoming unsustainable. And I didn't like his answer. He said, no. I believe interest rates are going to remain very low for very long, and our cost to service debt will therefore be very maintainable. And I followed up and I said, okay, well, let me ask you a question. What happens if interest rates don't stay low? He said, okay, well, then we're going to have a choice of bad options. We're either going to need austerity or we're going to have to inflate away the debt. And I said, okay, which do you think is more likely to happen? And he said, developed economies always inflate, always inflate. He wrote the book, of course, This Time Is Different, has studied, every major economy over the last 3,000 years. So it's not a big surprise that we're going to devalue the dollar. The only way out. The question is what to own in a devaluing situation. Wall Street's going to tell you own stocks because as you have inflation, stock prices go higher. Well, that does this. And what I think investors are going to find over the next, 2 to 3 years is a lot of face ripping inability to go anywhere. You're going to see markets really volatile. If you're trying to trade it, you're going to be stuck. You really need to take a position, I think, whatever it may be, and not be thinking about, what's going to happen in the short term, but really be thinking about what's going to be happening in the long term and try and avoid it altogether. So that's, I don't know if that answered your question, but I believe that the Federal Reserve is going to get reasons to slow down. CPI is going to likely go down relatively. You're going to see probably unemployment go higher. The conundrum there is the entire employment structure is shifting. We've got, baby boomers who have left the system, who most of them aren't coming back unless they absolutely are dire situation and need to work. And you've got young people that really are not incentivized to work. Why go to work when I can make, 1.25 times that getting my check, right? So you said a crisis and what you do in a crisis. We literally, gave away $600 a week to every single, low-income employee person in the country. We handed out money. We became socialists in what's meant to be a capitalist system and is all under the guise of crisis. So the big question really is, what is that next crisis? And is it something that we manufacture? I think we're probably headed for multiple potential crises, debt crisis, hot war, China, Taiwan, Russia, commodities. It's all happening in what is a beautiful definition of Neil Howe's fourth turning.
Yeah. Yeah, I mean, as we speak, we're now actively sending tanks to the Ukraine. That's not going to go over well. And Germany's doing the same. I want to go back to, it's news to me that they rejigged the CPI, because it goes to the question of rising money supply being inflation versus what people see, which is the price of eggs. And CPI measures things, well, not the core CPI, but CPI measures the price of things, the things that people see. And if they went to a 1-year cycle, then
Yes.
it will go down.
I think you're likely to see it go down. Larry Summers, former Treasury Secretary, and I think he's at Harvard. He wrote a big paper, and he said if CPI today were calculated the same way it was in 1980, CPI wouldn't be 5, 6, 7%. It would be 14, 15, 16% today. So the thing about the data and, this idea of fake news is we keep changing the way that the scale is measured. And so, if you keep changing the scale, look, you can stay the same weight forever if you keep adjusting the scale a little bit each year. Oh, I weigh the same amount. You're getting fatter, but we're changing the way the scale is weighted so it doesn't look like it. So the input is not giving you a real measure. You don't have to be a rocket scientist to know that the cost of everything is going higher. Okay, people on fixed incomes are struggling. CPI will run, inflation will run higher than the yield on the long bond, which is the 30-year treasury. It is the only way out. So if the 10-year treasury is at 30-year treasury is at 3.5%, you can be sure inflation is going to be 4, 4.5, 5. Okay, it's called financial repression. What happened in the 40s, what happened in the 70s. It's actually what was happening in the 2000s, and it's going to happen again. And it brings me to an interesting data point that you might find interesting, Addison. Do you know how much stocks have returned on an annual basis over the last 50 years on average?
I'm going to say like 6%.
6% after tax. It's 10% is the nominal number. Okay. Do you know how much gold has returned over the last 50 years on a nominal basis, average?
Oh, on an annual basis.
Yeah, annually.
It's got to be somewhere around 20.
No, it's 10%.
Is it really?
Stocks and gold over the last 50 years have each returned 10% annually over the last 50 years. So you look at that and you say, I guess it really doesn't matter what I own until you recognize that there are decades where the stock market returns 0. And in those decades, gold has gone up 8-1. And then there are decades when gold returns 0. And in those decades, you've seen financial assets explode. We're coming off of a decade where the Federal Reserve propped up financial assets. Gold did nothing. Gold was 1900 in 2011. We're right there now. So we've seen a massive increase here. And if you just play the numbers, okay, every decade or so we shift over. Warren Buffett made a bet in 2008. You're probably familiar with it, where he bet any hedge fund manager that the S&P index would outperform all hedge fund managers over the next decade. It ended in 2018. It was the easiest bet ever. He destroyed the competition because indexing became so popular and because the Fed, he recognized what the Fed was going to do. I don't know this. If I got to sit down with Warren Buffett, I'd ask him, would you make the same bet today over the next decade? I think he probably wouldn't, because that works in a disinflationary environment where you're in control. Federal Reserve, the easiest way now to think about this is a simple story. Gold is the anti-dollar. Okay, you can think about it that way. Gold is the anti-dollar. The more powerful the Federal Reserve is, the less attention gold gets. When gold really moves is when the Federal Reserve loses control. Politically, you're going to see a massive pushback from politicians if they try to keep rates high. Elizabeth Warren's on Twitter every day talking about the Fed needs to cut rates. Fed needs to cut rates. Okay, so politically, it's going to be very difficult for the Fed to not cave. On a performance basis, we're going to have a recession. When it comes, how big it is, can we immediately lift ourselves out of it like we have in the past? These are the big questions that I guess we'll find out.
Yeah. Well, that's kind of why I'm pressing on what you think what the pivot would look like and when. The reason why I'm pushing on that is because I do think it's politically motivated, but also because that the Fed, they're the real tool, the one that no one talks about, is money supply.
Right.
And we used to talk, I remember even when I started writing in the 90s, we used to talk about money supply all the time, but nobody talks about it. It's it's Basquiat's old thing, the seen and the unseen. People see prices for things, but they don't see the money supply growing. But the money supply has been growing continually for, as you say, 40 years.
Right. Well, consider a couple data points that you might find interesting. Markets bottom after the Fed stops, after the Fed pivot. Okay, the market bottom over the last 5 recessions hasn't occurred until after the Fed stops, number one. Number two, markets have never hit bottom before the VIX hit 45. The highest the VIX got was 37. So by that metric, we haven't hit bottom.
Yeah, just to be clear, the VIX is the volatility index.
The volatility is correct. Right now, it's been around 20. In fact, I don't know when exactly this interview will air, but one of the shorter term trades I'm thinking about is buying the VIX. People have sold insurance like crazy. It basically represents how much insurance people are buying. And when the VIX goes lower, it means people are, buying less insurance. It's not because they are less concerned. It's because selling the VIX is a algorithmic trade that just grinds people's, like picking up pennies in front of a steamroller. When it breaks, it typically explodes. And if you're, the VIX blowups have literally blown up hedge funds who had, hundreds of millions of dollars invested in this strategy of selling volatility that when it cracked them. So I think VIX is a place to look, but it needs a catalyst. Like we have so much AI, right? We have so much data. We have so much. You ever watch the pre-market? You see how things move on a data point, and you don't have a chance to trade it. Literally, it moves 50, 100 points on the S&P 500 in the pre-market on a CPI number that is whispered, 0.5% less, or, 0.1% under, right? The entire market explodes. When stocks lose 20 or 30% in the overnight and you're stuck holding it, you really can't beat or outrun the algorithmic and the technology and the trading. You got to make that decision well before. And so, it kind of goes to strategy. Is the Fed going to pivot? Well, yeah, of course they're going to pivot. Okay. It is the only thing they can do. When exactly they do that, and then what will that pivot really mean? I think the next pivot is going to bring a big sell-off. I think the next pivot's going to maybe see a burst higher because that's going to be the trade. And then you're going to see the smart money come in and go. They're not pivoting because things are good. They're pivoting because things are terrible. And, it brings me to why I think over the next 2 years, you're going to see profit margins really squeezed. Corporate debt is based on something called LIBOR. Okay. Which is London Interbank, rate. Corporate debt is on LIBOR plus. Okay. So corporate debt is floats. Okay. It's not fixed. It's relative. And if you're a company that has, you're not Apple or you're not Google, you're LIBOR +4, LIBOR +5. LIBOR was 0.5% 14 months ago. Okay. It was under 1%. LIBOR is now 5.5%, 6%. So the cost to serve as debt are not just a, governmental issue. They are a corporate issue that's happening across our country. And at the biggest companies who have the best credit, even better credit than, the US, right? I think Apple's credit rating is better than the United States. They're going to be fine. They're sitting on a lot of cash. They generate cash. But for most companies who are not used to seeing this expense dramatically rise, you naturally, you have to either grow with it, or you're going to have to cut your labor force, cut your costs to pay these other things. And that's the debt spiral that, I think that the world is at risk of falling into right now, Addison.
Yeah, but in a very real sense, that is the Fed's goal, and not to be conspiratorial, like you were saying, not to generate a financial crisis, but to reduce demand. I mean, that's the stated goal of raising interest rates, is to reduce demand to meet supply. And that's what brings the inflation situation into balance.
But you can't control the supply. You can only control the demand. So, look, I don't want to be conspiracy theorist either. I just know one thing. Russia invades Ukraine and China shut down. Okay. It was almost as if they wanted to, keep that inflationary pressure under wraps and really control their own economy because they understood what was coming. The supply is where the problem is going to be. Supply of labor, of natural resources, of, just think about our immigration problems. The reason we need immigration in this country is, most Americans don't want to go work out in our agriculture and be paid $10 an hour. You can't live on it. Okay. You got a situation where you need a labor force that was willing to take a lower price. We've outsourced all of our labor to China, Vietnam, to, emerging markets and third world countries. And those countries are now pushing back. So while we can impact the demand side, while we can tamp down demand for credit, what we can't do is increase the supply. And it's going to go like this, because inventories are now, what do? Do you store up your inventories? Do you, let them go? You don't have instant access. These are really big, complicated kind of like variables. And why, I know it's the conundrum you're focused on talking about with your investors. It's the conundrum we're focused on talking about all the time. And why I think you got to figure out what kind of runner you are. Are you a sprinter? Or are you a marathoner? If you're a sprinter, man, there's all kinds of signals. Okay. You can, do all kinds of trading platforms and work off trading signals and algorithms and all of it. If you're a marathoner, you got to look and go, okay, well, where are we headed here? We're headed for $60 trillion in debt. How do we do that? Well, we either massively expand the balance sheet, or we have actual live negative interest rates, or we have a reset. So, it's not hard to see where we're going long-term. And, it leads to that idea of the asymptote and gradually and suddenly. Smoke cigarettes for 30 years, no problem, except the cardiac arrest happens all at one time. So we're going to feel that cardiac arrest of our debt exploding at one time. The biggest issue, no one's worried about it because we always come to our senses. But we've got a Congress that is now motivated to fight back against this. And you've got so much extremism that the debt ceiling, which is really something we shouldn't be worried about, now actually becomes something really to worry about. And this, 10 or 12 people that, held McCarthy from getting, elected as speaker, that's an indication of how rough it could be when we run out of these extraordinary measures in late May or June that Janet Yellen's been using to pay our bills. And you go, wait a second, that could be the crisis that sparks it all. Now you see the 10-year treasury not at 3.5%, but 4, 5, 6, because who wants to buy our debt? And so that's the question I'm asking. Do I want to own debt for any length of time when I know the fiscal situation? I mean, that's like lending, money to my buddy in college who I knew never had a job and was, just bumming off me all the time. Like it's a bad investment. You do it maybe because you want to hang out with them, but you don't do it because you expect to get paid back. So if you lend the government money today, do you really expect to get paid back in any real dollars that are worth more? I don't. So I think you're going to see the dollar dramatically devalue. I think it's what the United States needs to reinvest here at home, to restructure the way that we run our businesses. And that oxymoron of weak dollar, stronger country is actually, I think, where we're at. And when we can get, I think the next president could very well run on that type of story, which is like end the Federal Reserve, end this manipulation. We need a weaker dollar. We need to reinvest at home. We need to bring it home. And we'll see if that's the direction it all goes. Seems pretty likely to me.
You're singing my song. I just put to bed Demise of the Dollar, and these are all the themes that I cover.
Yeah, well, you're right on it. I mean, maybe it's one of those. It's interesting. There's this saying, do you like it because you own it, or do you own it because you like it? Right? I own what I own because I like it.
Yeah, both things could be true, by the way.
They can. And, it goes to this idea, you only get converted once. You get confirmed regularly. So, when I think about, if you're following our stuff, we don't publish every day. We're not out there trying to pump it all the time. I've never allowed anyone to run an offer to my list. Okay. I've never sold someone else's product to our list. It's sacred. But I'm aware that not only do you need to speak to the converted, you need to confirm them, right? They need ongoing, you need to go to church, every week to hear the message and be reminded of what you believe in. But you also need to convert new people. And that's the challenge of financial publishing. When you get this story and it becomes more complex, but it makes more sense. It's almost like you understand the universe and you go, wait a second, the more I understand, the more I believe in God. The more I understand science, the more I'm certain there's a God. And so it's hard to tell that whole story in simple ways. So that's the challenge that we have, is how do you simplify all of this for someone who's coming to it for the first time, while still adding value to those who are already, in the church, but need, that sermon to keep them focused on, we're still focused on the right thing here.
Yeah. I have two more questions for you. And they're probably Pandora's box, both of them. But so one way to get out of the mess is to inflate away the dollar. That's what I call the demise of the dollar. It's been going on in earnest since 1971. The second way that you mentioned was to reset, like we did in 1971. What do you think a reset looks like this time around? Because we talk about Klaus Schwab and the World Economic Forum and his his book about the pandemic being the beginning of the Great Reset, and the sort of the authoritarian elite who are going to just reorganize the financial system. And it seems like fantasy to me. Well, but there's some version of that going on anyway, and the markets are going to force it. The Fed's going to force it. Politics are going to force it. And then you've got the global elite that want some version of it. So how do you see it coming about?
So if you go back to how the Federal Reserve was created, J.P. Morgan created the Federal Reserve. And the reason he created the Federal Reserve is his brainchild. Is he had been the lender of last resort in two major recessions, and he didn't want to be that guy anymore that to bail everybody out. It's like, we need a central bank that can bail everybody out. I can't keep, being the lender of last resort when things go haywire. And he set the Federal Reserve up in a system that would be backed by gold, that for every dollar printed, there would be 40% backing in physical gold. And that's what the foundation of the Federal Reserve is. We did something I think it's never been done, and people have been blown away when they see it. We created a tool, and we went back and we put the balance sheet of the Fed in every year since it's been created, And then we measured it against the money supply. And that leverage ratio is meant to be 2.5 times. Okay. 40% backing is, 1.5 times, 2.5 times 40 is 100, right? So it's a leverage ratio of 2.5x. And we then looked at that leverage ratio over time. From 1955 to 1970, after Bretton Woods, we held on to that deal. We didn't expand the money supply without also expanding the gold supply. But beginning in around 1955, we started expanding the money supply. Keep in mind, we had the beginning of the Vietnam War, the Korean War, we had the new society that we were all investing in. So we're spending way more as a government than we had. And our coffers of gold starting to get depleted. So you saw the gold going down like this and our money supply going like this. And in the 15 years, our gold supply went from 20,000 down to 8,000. Our leverage ratio went from what was about 3.5, 4 to 20. And that's when Nixon closed the gold window because all of the gold was leaving. So I believe a reset looks like a resetting of that system. Every central bank in the world holds physical gold. So a reset in the gold price deleverages everyone. Okay. If gold is sitting on our balance sheet and instead of, it's an interesting thing, it's valued at $42 an ounce still, but we're actually valued at the market value of say $10,000. Well, our balance sheet is not leveraged at all. So you get back to an original leverage ratio of 2.5 times by resetting a gold price, which everyone owns. So for me, I think that's the reset. I don't see it as a digital Bitcoin type of thing because you need an exchange. You need to trust. You need a system that isn't reliant on trust. Gold is an asset, not a liability. And why I think the reset will likely come from a manipulation of the gold price. It's what happened in 33. It's what happened in 71. And I believe it's where we're at again, call it Bretton Woods 3, right? We're in that moment right now. That's the Great Devaluation.
Second question I have is you're writing The Return to Real, and you're talking about actual solutions that people can follow in the case of a debt spiral or a reset, or even just increase like a extended inflationary period. And you're talking about rebalancing from the traditional 60-40
Sure.
stocks and bonds to 40-30-20-10.
I am, yes. That's look, once you get the conclusion that if interest rates continue to go higher, you then got to go, well, how will that in fact impact the 60-40 model? The stock market was 800 points in 1964, the Dow Jones. It was 800 points in 1980. If you look at that on a nominal, go, yeah, I put my money in the stock market. Yeah, it's around where it was 16 years ago. I didn't gain anything. No, you're looking at it the wrong way because you've lost 75% of your purchasing power. A stamp cost 5 cents in 1964, cost 20 cents in 1980 is the easiest way to look at it. Bond values went down 50% in that same period of time. So in a inflationary time, stocks and bonds are not historically what you want to own. What you want to do is be thinking about, okay, how do you rebalance a portfolio if that is your main conclusion? It is my main conclusion. I think we're going to have elevated interest rates for longer. So the way I think you should be doing it is in a 40-30-20-10 model. I have been talking about and researching it and designing it. I have not allowed, I haven't published it yet. I've opened a $1 million charity account where we're preparing the 40-30-20. Right now, I got to be honest, I've got personally, I'm about 80% in physical metals. The rest is sitting in short-term 3-month treasuries right now. And I'm waiting. I think that the time for that model, Addison, is going to come after the Fed stops hiking, that's when to really start to be thinking about how to reposition. But I think it probably comes with an S&P 500 that's closer to 3,000 than 4, that comes with an entry point that is far better for long-term investors. And now you can rebalance. And, you want to be looking at these types of things, tangible, real assets. There's a great chart, which is the commodities to equities ratio. And if you look at this thing, the commodities to equity ratio goes in and out of balance. There's times when it's great to own commodities, times when it's great to own equities. We're at the level that it's never been better to own commodities over the last 100 years than right now. So you've got this great timing if you see the world the same way, and you want to think about how to invest in that way, and why I'm sure I'm going to be relying on you for some of the, ways to do that in these different pockets of the portfolio. I'm really good on the gold side. Okay? I can tell you how to do it the right way. I know how to own it. In fact, we were the only, we were given access to the Delaware Depository. We took cameras inside it, never before done, where you could actually see the metals. And much of that's because I own a lot of metals there. So if you want to understand how, the risks associated with it, that's the other thing that no one's really addressed. Yesterday, okay, the Dow Jones broke. There was like 100 stocks that you couldn't trade that literally moved 5 or 6% before they fixed the problem. Okay, so what's the next reset look like? I don't know. Maybe that was a trial run for the market broke. You opened your account, you had $1 million, you opened it, 2 days later when you could open it again, and you had 700,000. What are you going to do? That's what it says. That's the digital world we're in. And why now more than ever, you got to have things that are tangible and real that you can control. So I think I might have gotten off the question, but the 40, 30, 20, 10 model really is thinking that through for a long term and how to balance a portfolio in new ways. I think you want to own emerging markets. I think you want to own tangible commodities. I think you want to own, some shorter term, shorter dated treasuries. And, that's the combination probably moving forward.
Are you, you said you're writing it. Have you published it yet?
Well,
and when you do publish it, is it for paid subscribers or are you going to have it on your website?
Well, you've now touched on, the transition I've been making from, my primary focus being on the gold company to now the primary focus being on the publishing. I'm not allowed to give financial advice. The reason I set
Nor are we.
Right. So, we probably should have started this whole interview with nothing here is intended to be financial advice because, but what it is intended to do is allow people to follow what I'm doing. So the charity account was set up for that very reason. And the allocation is something I'm going to share with subscribers. Yes. And it's not going to be something that, I'm going to say, go do it. It's going to be something you can just check into and see over time and see how I'm changing or what changes I've made. My ongoing writings are going to be talking about the things I'm noticing that, of causing that mindset to change. And the reality is, look, if the data changes completely, if something changes dramatically, I'm open to changing my mind. I think we've got to restructure our debt. The easiest way to think about it. When you are running on credit cards with interest payments through the wazoo, you restructure. You go bankrupt, you restructure, and the company you owe the money to says, okay, we'll take 40%. Okay, we'll take 30%. Right? Let's get us something. And that's going to be the restructuring that happens for, debt investors. One last piece on that. We've had a 40-year bull run in debt. Meaning if I'm a lender, I've had a 40-year run where I've always won. And I've won at the expense of real tangible things. So I think you're going to see that pendulum reverse. That's what the 70s were. That's what the 40s were. That's what the 2000s were. You had a lost decade. We're going to see this, I think, a similar thing in the coming years, and why you really want to be thinking, if you're a marathoner, a long-term investor, about how to restructure a portfolio long-term. Short-term, I like being as much look, Tina, there is no alternative, was what ran the stock market for, the last decade. Well, there is an alternative now. My money market pays 4.5%. So you go, hey, you know what? Maybe cash in the short term really isn't the worst place to be if I'm getting, 4.5%. Let's see this thing shake out a little bit. Let's kind of sit on the sidelines. But the 40, 30, 20, I think will be ready to be released when the Fed is a little further in this path.
All right, final question. Eagles?
All right. So I'm going to the game. I'm taking one of my best friends and an employee. And the Eagles he's a San Fran fan.
Oh no.
The Eagles are going to it's going to be ugly for the Niners. Brock
As
Purdy,
ugly as New York?
well, I don't know. Look, San Fran's got a good D. Brock Purdy, though, is a small guy. It's going to be cold, and he's got smaller hands, and he's going to be facing a very a different type of energy than he had, in San Fran with the crowd behind him. So I'm a huge believer in sports, particularly that the crowd and the energy is real. I believe energy is real, and that momentum is going to be difficult for a rookie to overcome. It's could be like war. And if we can not turn the ball over and play, I think it's going to be a pretty easy, win for us.
Pretty easy road to the Super Bowl.
So listen, what's crazy is,
do you have any opinions on the AFC?
You're probably not going to release this until after that game. I'm either going to look like an idiot or, this guy really knows what he's talking about. Sports
it actually comes out. It comes out the day after.
Okay. Sports is not my primary thing. So if I'm wrong, please don't judge me on don't throw the baby out with the bathwater.
Do you have an opinion on AFC?
Mahomes' injury, I think, really changes the.
Yeah, I do too.
I don't know. You have to wonder when a team can score that quick when they're down, like the Kansas City Chiefs could and can with Mahomes, mobile. You go no lead safe, and the one thing to do if you see the Kansas City Chiefs and a good Mahomes and they're down by 14, just bet the over. Take the in-game over, because they're going to find ways to score, and the other team is going to have to keep pressing to keep the lead. So one of the strategies that's, I've done pretty well with the new sports gambling bets is in-game playing those moments of really, totals, particularly. The odds makers are pretty good. They set a total at 48 and there's 31 points scored in the first half. You're getting, under 69. You go, oh yeah, I'll take it. I'll take the under. I think it's probably an odds on bet. And it's, the sports betting sites are designed to cater to donkeys. Okay. They don't want sharp money. So they limit your bets. They don't want traders in here. They don't want guys in here going, oh man, this is a good price. Let me buy it. Not because I like it, because the price is good and the odds are the buying at the right price is, the battle. So yeah, I'm a homegrown guy. I love Philly. Go Eagles. So if they're there.
All right. Well, it's great to talk to you. This is a good conversation. And like I said, we'll be publishing right after the game.
Addison, this is awesome, man. I know we probably went way longer than what you normally edit together, but I'm really interested in how I can help you promote this.